Everybody feel free to join in as you like.
Okay, so the article we're presenting today is a report on Manic markets.
So just a little background on the situation surrounding the article. GameStop, going by the ticker GME, is a well-known brick and mortar retailer specializing in video games and gaming accessories. GME originally IPO'd on February 14th, 2002. So this isn't a new company to the market. They've been around for over a decade on the New York Stock Exchange. And many consider their business model to be antiquated, and the company has been in steady decline in the past couple of years. Consequently, the company's shares had seen little to no growth in recent years and had been stagnant up until last month. Due to this, many large hedge funds such as Melvin Capital aggressively shorted the stock, hoping to profit off the company's seemingly inevitable collapse. And at the time, this seemed like a good decision for the hedge funds. GameStop had been enveloped in bankruptcy rumors for a while. They weren't seeing the sales they expected on the new video game consoles. So to the hedge funds, it seemed like a smart investment and pretty risk-free. GME's short float, the number of shorted shares divided by the shares available to the public, peaked at an absurd 140%, leading many to believe the hedge funds had been engaging in naked shorting. And naked shorting is an illegal practice of short selling shares that have not been definitively borrowed nor confirmed to exist. Now,
so there were more shares sold than shares outstanding.
Yeah, 140% actually. And here's just, let me see if I can. Oh, sorry about that. Oh, here it is. And here's just a little graph to show how the short interest has changed over time. You can see GameStop was a pretty highly shorted stock for most of 2020, but toward the end of 2020 is when it really picked up steam. And if you notice that little drop off, that's about where the craziness starts taking place.
But it had been, even if we go back, it looks like to mid-19, it was, even in 19, it was starting to go up.
Yeah, it's been getting shorted for a while now. This wasn't anything new. I think it just took people a while to catch on, and you can see it steadily rose. And I think once it reached over 100% short interest flow, I think that's when people started to catch on that something was up here.
Okay.
No.
So this was primarily the hedge funds that were shorting the stock they didn't hold.
No, they didn't actually hold any shares. Like I said, it's an illegal practice known as short or naked shorting.
Okay.
So they never had a confirmative agreement with any brokers to borrow the shares. And that's not something an average investor can do. Like, we can't go to our broker and short shares without a contractual obligation to return the shares at some point. But that's just one of the advantages that the massive hedge funds had.
Okay, so you and I couldn't do this. We have to just, if we're going to short, we have to have a contract for the position.
Exactly. And it's supposed to be illegal. The SEC is supposed to enforce rules against it, but there are loopholes around it, and it seems that's what the hedge funds were doing.
Quick question. I'm just shocked that they're able to short more shares than even exist. Like, that's just...
I could probably explain it. I was looking into it because it doesn't make the most sense, but basically, say someone's holding the shares and I want to short them. So I take the shares and I sell them right away. And now someone else picks up those shares, and then the broker allows them to be shorted again. So now you're going to reach over 100% if you continue this practice.
But if I'm shorting, there's an opposite. There's another side of the transaction?
Right. If you're shorting the shares, like you have an agreement with your broker, it's usually in the fine lines where they can short those shares. And basically someone else takes them and sells them right away. And since you were going to hold the shares anyways, if the stock price drops, I can sell them back to you at a lower price. Doesn't matter to you because you were going to hold them regardless. And to me, I sold them back at a lower price now. So I make that difference.
Got it.
But if you want to make over 100%, these people, they sell the shares right away, because when you're shorting, you have to buy to cover when you're done because you sold them in the beginning. And those same shares can be bought up now. And if they're shorted again, you're going to go over 100%.
It's like a Ponzi scheme.
Right.
It's just like creating them out of thin air. I don't even...
Yeah, so if everybody, when it was at 140% short, covered their short positions, what would happen? Because obviously there's
We'll get
shares
into
that
that a
people
little
buy.
more. It would simply be a massive short squeeze, and you would see
The price
action
moving
similar.
on.
You would see similar action to what we did see with the price
Yeah.
spiking so violently.
Because
Yeah.
people would need to cover the shorts.
Exactly, trying to cover shorts when the shares never existed in the first place. So then you're getting into a supply problem.
Wow. This is crazy.
Yeah. But that didn't seem to, I mean, some stuff, I mean, really, until you started explaining it, I never really understood that. Now that I do, that makes the situation even more crazy.
Yeah, you can see once you realize what the hedge funds were doing, how aggressive they were with their shorts, and how they didn't even hedge against anything, you can kind of understand why it spiked so violently.
Wow.
So as investors caught wind of the short attack on GME, internet forums, namely a Reddit forum going by Wall Street Bets, began rallying their members to purchase shares in the company. In the course of this, Wall Street Bets blew up and actually gained millions of members. The rally cries of Wall Street Bets spread like wildfire across the internet, garnering headlines and becoming a top trend on Twitter. Posters span the terms "to the moon," "diamond hands," and "stocks only go up." And "to the moon" refers to the stock chart rising. They say it's going to the moon. "Diamond hands" refers to holding your shares through anything. They say you have strong hands, hence diamonds. And "stocks only go up" is a popular meme saying, they say. And as the momentum surrounding GME grew, the most daring investors began to purchase short-term out-of-the-money call options. As the price of GME violently rose, some hedge funds and institutional investors covered their shorts, while others actually doubled down on their short positions. What would happen next is one of the greatest short squeezes ever seen in the history of finance. So just a little brief background on what a short squeeze is. Simply put, a short squeeze arises from the basics of supply and demand. As the stock price rises, those with short positions will look to cover their positions and close their shorts. In order to cover, shorts must purchase shares at the current market price in order to return them to the lender. As a result, shorts buying up shares to cover, the demand for the stock rises as the supply shrinks. Because why would investors want to sell a stock that's rising?
So then the price goes up and it costs more money to buy it back.
Exactly. So it's an avalanche effect. And as the buy orders roll in, the share price rises. As the share price continues to rise, more and more shorts are forced to cover their position, whether they're getting
That's sort of like the brokerage firm makes you cover your shorts because your exposure is too great.
Exactly. It's almost, it'd be a margin call. Eventually it'd become a margin call because your equity would decrease so much. Now, the hedge funds, they play by a different set of rules. They're not exactly getting margin calls because they're not borrowing shares from Robinhood or something like most of us are, but it's the same principle. They're losing their equity in the position, and eventually their lender is going to step in and make them cover. Now, this results in an extremely bullish cycle of shorts driving the price up higher and higher as more and more attempt to cover their positions. And pictured below is just a simplified candlestick chart. And you can see as the stock price goes down, it eventually hits a bottom. And once it hits this bottom, the short squeeze begins, and it just grows higher and higher and higher.
And then you throw in the covered call, you throw in the calls.
Right. Yeah. Because
Yep. Then you get a gamma.
calls.
So
Then
now
you get a
got
gamma
the
squeeze on
equity's
top of
supposed
the
to
short
call,
squeeze.
and some of the same parties doing both.
Mm-hmm.
Okay.
Now, just a brief history of short squeezes. Short squeezes are nothing new to the financial market. One of the most famous short squeezes was Piggly Wiggly in 1923. Piggly Wiggly is a common supermarket chain across the United States, mostly centered down south. Clarence Saunders, the founder of Piggly Wiggly, saw his grocery chain battered by short attacks and wanted to get back at the bearish investors. To do this, Saunders took out a loan, boarded a train with 4 armed guards, and arrived to the New York Stock Exchange with millions stuffed in a suitcase. By March of 1923, Saunders controlled 99% of all Piggly Wiggly shares available to the public. Since he owned all the shares, Saunders could theoretically set the price at whatever he wanted. The short sellers would have to buy the shares from Saunders to cover their positions. He had them cornered. Eventually, though, Saunders attempted to privately sell his shares off the market. He actually took out ads in the newspaper offering investors a chance to buy his shares at $55 a piece without going through any exchanges. And thus he faced investigations by regulating boards, leading to his defeat and eventual bankruptcy.
That's crazy. The amount of power he had to buy up almost every single share.
Mm-hmm.
I can't even imagine a public
But he was
company.
doing it on purpose because people were trying to hurt him. It was a defensive move.
Yeah. He wanted, it's pretty much him looking to get revenge on the short sellers, kind of similar to the GameStop situation where you had investors trying to get revenge on the hedge funds.
It seems like counterintuitive because most business owners are like, you want more people to buy your shares so the demand goes up and price goes up, and he just was like, his ego was hurt, so he just took them all for himself because he didn't want anyone to hurt his feelings anymore. That's just funny.
And once he owned all the shares, like I was saying, he could set the price wherever he wanted. So it was literally impossible for the shorts to cover their positions. He wouldn't sell them the shares to cover.
Wow.
There's been a number of these throughout the time. One other one that comes to mind is Valiant Pharmaceuticals.
I think Volkswagen was a big one, I want to say, in 2008. And I think they had an even greater short-term spike than GameStop had.
Wow.
Now for the specifics of the squeeze on GameStop. The squeeze on GameStop was no different than other short squeezes throughout history. The actors in this case were the millions of online investors putting whatever funds they had, big or small, into the struggling meme stock. GME's violent rise can also be attributed to a gamma squeeze. A gamma squeeze is a short squeeze on steroids. It results from sellers of call options buying the underlying security to hedge against the call executing. The previously mentioned short-term calls were now in the money, and sellers scrambled to buy the underlying shares for the upcoming expiration date.
So I didn't own the underlying. I had to deliver.
Yeah, they had to. So as it gets closer to the expiration date, they're realizing, I mean, the share price is at $200. I just sold a call option at $40. I need to buy the shares now so I can cover when it executes in a couple of days. So thus the short squeeze coupled with a gamma squeeze on call contracts led to the violent spike in GME's share price. And you can see here are two price charts for GameStop and AMC. AMC was another one of the meme stocks. It didn't go to the extremes that GameStop had, but you can see it did follow a similar price pattern.
Why do they call them meme stock?
Because they did make a lot of memes about them. There's a lot of jokes about the stocks and just the way they're being pumped on the internet forums.
Okay. I see.
And it wasn't just GameStop and AMC. It was also Nokia and BlackBerry, which is kind of funny considering BlackBerry, Nokia, AMC movie theaters, and GameStop. Those are all, they're in similar positions financially where you would think all those companies could be facing bankruptcy soon. They're kind of all stocks of the past, if you would say.
Right. They were coming at all types of stocks that are highly shorted by institutions.
So some of them clearly had no fundamentals behind them.
Oh, none of them had fundamentals.
That's why it's a joke.
AMC, Bed Bath & Beyond, you got to throw in there too.
Yep, also Bed Bath & Beyond, yeah.
And
actually, it had widespread effects on the market. I believe on January 26th, as GameStop and all these meme stocks were seeing their huge spikes, people were going on to stock screeners and finding stocks. Any stock with a high short interest started spiking in the middle of the day, just based off the idea that this could happen to any stock.
That's heavily shorted.
Yeah. And here's just a little chart illustrating the stock option activity over the past 2 months. You can see how the call volume steadily increased and then spiked towards the end of January. And you can see how the call volume preluded the giant spike in the GME share price. So this was kind of a warning, you would think, to hedge funds to maybe close their positions. But like I said, a lot of them doubled down, and that's what led to the violent spike.
So the retail essentially is, as I understand, the retail investor saw some of this, saw the hedge funds doing it, and didn't play ball with them and screwed them.
Exactly. You would think the common thought before this was, okay, the hedge funds know what they're doing. If they're shorting a stock, there's something bad about it. Follow the trend with them and make money off their trend. And they completely went against that. they fought against the hedge funds, and it ended up working for a lot of people. So like all good
Any
things.
of the analytics we're doing in this class, we would find that there is nothing to GameStop. There's no strategy. There's no results. There's
No, and like I was saying, the way they spread their rallying cries like diamond hands, a lot of people actually got hurt by this because a lot of people, they didn't sell at the top. They held through and they held, and everybody that bought shares on the way up, I mean, GameStop's now trading at $40. There's tons of people that were buying shares on the way up at $100, $200 that got burned by this. So it wasn't all success for the retail investor. Only a small percentage were able to get out at the top.
Were you in any of these?
I was in Nokia, and what happened, I was in Nokia, I got in midday and was riding the momentum on it. And then the very next day, Robinhood put in the restrictions on purchasing new shares in it. And so I just sold mine. I didn't want to be involved at that point, and the price crashed after that.
Okay. Chris, you in it?
Yeah, I was doing the same thing. I never bought GameStop. Everybody used to buy a lot of puts on GameStop, and I never was a believer. I mean, consoles are coming out, they're getting rid of disk systems, they're getting rid of everything that GameStop sells, and the only incentive you have to buy GameStop is that maybe they'll make some money off like novelties and little like memorabilia from video games and stuff. So like there's no way I was gonna buy it. I saw it go to $60. Saw it go to $100, saw it go to 200. I was like, I'm not doing it. There's no way. But I did buy Nokia and AMC just to see what was going on because it was so popular and trendy. And I did get burned also when the restrictions came in. So I sold because Robinhood's biggest thing was they restricted the buy but allowed you to sell. So they basically forced the price to go down. There's no way I was going to come out as a winner.
So contrary to Wall Street Bet's motto of stocks only go up, GameStop did in fact not continue to rise. Brokers soon enacted restrictions on purchasing shares of GME and other meme stocks such as AMC, Nokia, BlackBerry. On January 28th, the popular trading platform Robinhood, that is the main trading platform of the retail investor, they put in place restrictions allowing investors to sell their shares but not enter any new positions nor add to their positions. So that's just basic supply and demand. If you're only allowing people to sell and nobody to buy, there's no demand for the stock and an overflow of supply, the price is going to crash. So these restrictions led to a crash of the company's share prices, and many investors lost their diamond hands. Many cried foul play at the brokers stepping in to restrict purchases, and there are now ongoing congressional hearings into the matter, opening the door for increased regulation. And one question to consider is, did the company GameStop itself benefit at all from this? And in my opinion, maybe nominally, but not really. GameStop is still a dying company. The executives at GameStop didn't sell any shares they held at this time because they have to have their prearranged sell dates. So this really had, other than the news headlines and the media surrounding the company, this really had no benefit to the company itself. So the fundamentals didn't benefit at all. Nothing benefited from this. And pictured below is actually the CEO of Robinhood, Vlad Tenev, at the congressional hearing. The congressional hearing that's taken place so far involved him. It involved a Reddit user named Roaring Kitty, who was one of the first to put people on to the opportunity in GameStop. And then there's Ken Griffin, the CEO of a major hedge fund, Melvin Capital, who his hedge fund bailed out another hedge fund who lost billions from shorting GameStop.
So with the whole GameStop thing, there's a bigger picture of everything. So like there's always the analogy of like why trees don't go to the sky, because the higher trees go, the harder they have to work to overcome gravity and keep pulling their water through their roots. And the effect on gravity that has on trees can be viewed the same as fundamentals on the overall market. And the fundamentals, some of the most basics are economic growth, earnings growth, and inflation, and they have major effects on the market. And the key here is that in the short term, the market can easily defy fundamentals. And this has been the one of the biggest years where we've seen that, especially with everything that's going on with the pandemic, and the overall market continues to go up. But in the long run, over history, fundamentals have always prevailed, and they most likely will. And it's just how it's always been. And we can see this concept applied as GME stock price has since fallen since the huge spike. And if we go to the next slide, we can see the price differences. So one more back. So yeah, so they reached a high of 483 per share. And earlier in the year they were trading $10, $20. So insane increases. And now it's back down to, I think yesterday or a few days ago, it was $40 per share. So we can see that things do come back down, fundamentals do prevail. And despite all of the Reddit trends and what everybody was saying that go to the moon, won't stop, we can continue doing it. If you held those shares, you really did ended up getting burned very, very bad. So this episode can be symptomatic of how the market can decouple from fundamentals for the time being. Now, if we look at the overall market as a whole and everything that's been going on the past year, the cyclical adjusted total return price to earnings ratio, or CAPE ratio, it's a lot easier to say, shows extremely high stock valuations despite some of the lowest interest rates we've ever seen since the 1880s. To further this point, as of early February, the Vanguard Total Stock Market ETF is it's basically just an overall index. It was trading at a fair price to fair value of 1.09, meaning the stocks are trading of about 9% above what they're worth or above their NAVs.
So what could we've been seeing maybe over the past 3 days or so could be some of this coming out of the market?
Right. Yeah, I actually added a couple of slides, especially after today. I mean, I don't know how you guys are doing, but a lot of people are getting burned. There's a lot of scares coming out. The overall market's not doing too well. Tech stocks are struggling. So there's a lot. We may see some of this start to actually prevail. The fundamentals may start to really, set their effect, because interest rates really have never been lower. And we've seen like a slight uptick, with very slight uptick over the last couple months. What we're seeing is just maybe just optimism.
It's still so small.
Right. It's very little. So
I
it
couldn't
would
see
have to
people
be pure.
out of equities into bonds at this small change that we've seen.
Mm-hmm. Yeah.
It's not.
Very small uptick. So yeah, it must be optimism. But we started these slides before the last couple of days, so if we keep going. So here's just some of those ratios. You can see the picture's a little bit below the line on the top graph is the long-term interest rates. And this goes back all the way to 1880, and it's below those rates. It's some of the worst we've ever had and some of the worst the economy's ever done. Yet the CAPE ratio, which is that fainted line in the back, continues to go up. And the CAPE ratio, again, is stock valuations and price ratios. So you can see the disconnect where, we have some of the lowest interest rates, yet the valuations are high. So some people like to ask themselves, especially with the uptick in retail investors and everything, like, our time's just different. Like, are we just in a different time? There's always people who say, history always prevails, market fundamentals will always prevail. And then there's some people trying to say that, maybe we're just at a different point in time. Things are different. You have different technology, different ways of trading, different traders, with all new types of people getting involved, what's really going on. Because we've seen the massive excitement around these meme stocks, which is just quote unquote, where there's lots of, companies that like GameStop, AMC, the list that we went on before, that just aren't really good stocks at all, yet they can still go up. And basically what we've seen is the power in retail investors, his ability to congregate over Reddit or any type of forum or anything that brings people together, and the real effect on the market. Because it was believed in years past that the only people who are moving markets are like the whales, the people with huge amounts of money who have the ability to pump and dump. Everybody knows the Wall Street stories back in the day, Jordan Belfort, blah, 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 all those kids. who had ability to manipulate the market by themselves. But now we're seeing that massive groups of people can actually conjugate and do that together. And we also see an extreme returns from SPACs, which are special purpose acquisition companies and blank check companies. These companies basically just form for the reason to, like, they form for the purpose to merge with another company. So I go through all the paperwork and all the hassle to IPO, and then now I have some incentive to merge with another company so that they don't have to go through that process, so they can save a lot of time and become public quick. And
that way, if I do that, if I just have cash, my form S1 is very simple. It's not complicated.
right, it makes things a lot easier. And this is relatively new. The SEC we may see them start to crack down in the future, but as of now, it's so new that they're doing pretty well. And I believe that traditional IPOs still yield higher returns. I'm not sure if that's changed in recent times, but a lot of people are profiting off these. A lot of these SPACs are doing extremely well, and a lot of it has to do with Reddit traders, retail investors, people, basically buying these based on speculation. Because when you buy a SPAC, you don't know if they're actually going to merge with the company that they're trying to. It's all speculation, and they're getting extremely high returns based on no fundamentals. So again, that brings into the huge increase in retail investors. Now everyday people can trade. I trade on my phone. Anybody trades. Back in the day, you wouldn't see as many people just getting into trading and buying stocks. So again, a lot more speculation, a lot less market fundamentals come into the buying and pricing of stocks. So historically, this really
the strategy would still work if we went through and found all the highly shorted stocks and looked at. You think that's still a strategy that's going to work?
Well, in theory, that would work because short squeezes are a real thing. But I think you'd see a much faster crackdown from the SEC or brokers like Robinhood, who restricted trades. So now that they know these things can happen, now that they're aware of them, they can catch on much faster and they can put things to a stop much easier. Because the SEC doesn't want anybody manipulating market prices, regardless of the free market and everything that goes into pricing. But so they're more than likely step in. We'll probably see a lot of change in legislation possibly over the next couple of years. But in early March, the market plummeted around fears of the global pandemic. Surprisingly, this was actually the shortest bear market ever recorded in history. We have, straight business shutdowns, extremely low interest rates, some of the worst and like unemployment numbers we've ever seen, and yet it's the shortest bear market we've ever seen. So a lot of speculation, a lot of optimism. And even now, almost a year later, while many people are still living in lockdowns, many of the markets are at their all-time highs. Obviously, the last couple of days have been rough, but we're seeing in recent news a lot of fears beginning to circulate around inflation and job loss concerns. But none of this stuff is new. So we've known this for how long, yet the market continued to go up. So this may be an example of like we're in a bubble and maybe things are starting to go down or pop. So as of today, the Dow is down 0.5%, S&P is almost down 1%, and NASDAQ is down 2%. So tech stocks are really taking a big hit right now. I know Tesla and Apple have been taking major hits lately, and there's been huge inflation shares. Cryptocurrencies are also taking huge losses. Remember, Bitcoin almost reached a high of like 50, maybe 52,000 or higher. And their price right now is much lower. Give me a second. But
yeah, I think they got to like 58 or 59.
Yeah. And same with, Ethereum taking big hits over the last couple of days after reaching new all-time highs. And basically, there's a lot of fear that's coming into the market. We're starting to see big sell-offs. And we're wondering, is this the long anticipated crash that we've been waiting for? Who knows? This has happened before. I remember earlier in the year, things started taking a big hit, but ultimately prevailed. A lot of people said things will happen with the election. Nothing happened with the election. So who knows what's really going to happen? But the biggest thing, in my opinion, is inflation, because we've been printing record amounts of money, and that's going to cause a big problem. And we also have the growing fear of these cryptocurrencies. And while they don't have enough validity yet, over time they can be seen as a hedge, because once they gain a lot of value, and if they consider, if it's ever considered a incomparable hedge to gold or something like that, people will take a lot of money and put it into there rather than, banks and interest rates. And other than that, interest rates are so low as well. So a lot of scares for US currency. And even today, federal chairman came out saying that, the increase in central bank interest rates are very far away, which is a big scare. So, you're almost a year later and we're still not seeing the improvement that all this optimism should have reflected. So what we're seeing is the market fundamentals finally starting to take a real effect on market pricing.
But wouldn't
And it's maybe
inflation
the
keep
beginning.
people in the markets? Because if inflation goes up, prices would go up, earnings would go up, that you would have to keep your money in equities, because if you had it in fixed income with high inflation, your money is going to be worth less.
I guess that's true, but you could also see people looking to other hedges.
Okay.
So they could take their money out, they could put it in gold and other securities. But I'm not totally sure why inflation causes such a
Or do we
decrease
just
in
go
the
up
market.
fast between January and February?
It could do that
And we're
too.
just sort of reverting back to the mean.
Mhm.
I
Because
think if you
overall,
look at
like,
it relative to the tech bubble,
mhm,
2000, some of you might have been born, others may not. Was everybody born before 2000 or in
I was born
2000?
on to.
In 2000.
In 2000 for me.
Okay. There's a huge difference between then and now. The most important one in my mind is a lot of the businesses that are highly valued today, or highly priced today, actually have positive cash flow. When you go back to 2000, there wasn't positive cash flow. That's a difference. The Fed had raised
Yeah.
rates numerous times over the preceding 12 months, and we were entering a recession. Now we have low interest rates and we're coming out of a recession. So you look at that and say, well, wait a minute, it's a very different environment today when we're having some of the same valuation issues as we did in 2000. So I think it is different. I think it's in pieces. There's certain parts of the market, certain equities that clearly aren't there.
Right. And then that's the big question we keep looking at, are times different right now? And, based on what you're saying, they very well could be.
Yeah. But again, you see the GDP growth for 21. I can't be, there was another one that I forgot who came out yesterday. They moved theirs up. I don't know if it was Morgan Stanley, but they're up to 6.1% GDP. That's crazy.
Well, because GDP is like 70% personal consumption, and we're pumping money into the economy and we're spending it. Big business, Walmart, all these guys are doing extremely well.
Which should be driving revenue, which should be driving maybe we're just catching up.
Right, but we see a lot of like these big businesses benefiting off it, but small businesses are, in very scarce times at the same time.
Yeah.
And
I think that also has something to do with the stimulus too, with the CARES Act being disproportionately allocated to bigger businesses and individuals rather than smaller business, which is absurd to me, but I don't know.
I think one of the biggest concerns will be the job losses and all the businesses that will continue to shut down over the next couple of years.
Crazy times.
Go ahead.
I was just saying crazy times.
Yeah. I do think that a lot of things have changed and we're going to do things differently, which will create opportunities for some. But I don't know how some of these smaller businesses are going to stay in business. I don't know how the small restaurants are ever going to survive. It just, I don't know how some of them, some of them are closed. They're just doing takeout.
Geneseo Family Restaurant.
I saw their
Me.
on.
Mm-hmm.
I mean, they've been there for 50 years. It's sort
Yeah,
of, go ahead.
just to add to what Chris was saying, how it disproportionately favors the big businesses. If you think about it, when the first stimulus checks were rolled out, your local businesses, they were all closed. At least in New York State, they were all closed. Your local restaurants, they didn't have drive-throughs. They were completely closed. So people got those stimulus checks and they took them straight to Amazon. They took them straight to Walmart. And those were the only places you could even spend them at because nothing else was opened.
Yeah.
But I also think you have to consider whether a market recovery, whether the reopening from COVID has already been priced into the market and it just happened too quick. I think we were due for a correction. I think the correction was overdue. And I just don't know what could happen in the short term for the market to make a quick recovery from the downs it's been seeing this week. So I think this could be a couple months until things really get reopened, actually get reopened this time to see the market recover and get back into a bull market.
Mm-hmm.
But to your point about how things have changed, the rise in retail investors will definitely have a bigger effect on the market going forward.
Huge. So do you think the individual investor is going to use more things like Reddit, Wall Street?
Oh yeah, like I think Wall Street bets before all this happened, I want to say they were hovering around 1 million members, and they might have already passed it. If not, they're closing in on 10 million members now. And just if you go on Twitter, you see stock trends trending every day. Like this morning, hashtag buy the dip was one of the top trends on Twitter. I think people, just the common person, is getting more involved in their own finances. I think people are looking to more manage their own money now. And I think that's going to be a growing trend going forward.
Yeah, I agree. But they may not have the skills and the knowledge to do that.
No, which leads
That's where all the
to
speculation.
which could lead to more situations like GameStop where it's all momentum based. There's no fundamentals involved. You see these giant spikes just based off momentum. And I think although I do think the rise in retail investors is good for the market, I think it's good for everybody to be involved. I think it will cause more volatility within the market.
Because they don't understand. They're making decisions based on rumor, not necessarily the strategy.
And they're going to want to follow trends. They're going to, this stock is rising, I should get in and follow the trend. So it's just they're going to cascade upon each other, and it's just going to lead to more overall volatility.
Mm-hmm. Interesting. And that brings in the big thing with all the SPACs. Those are pure speculative companies that you're buying your money in, and whether a deal goes through or not, stock price is either going to plummet or rise.
Do you have any SPACs?
I was in
FSR.
Fisker. I'm in 2 SPACs that I was in them before they merged. Now they've merged, Fisker and Golden Nugget Online Gaming. But I'm in one other one, Velocity, that is in the process of merging. But I don't know if any of you were in CCIV, Churchill Capital, but it was trading at $20 for a while, and there was news of them merging with an EV producer, Lucid. And in the past 2 weeks, the stock ran up like crazy. I think it peaked around $60. And then just yesterday, the news came out that the merger was successful. So you would think, okay, the stock's going to go up even higher. But no, everybody sold the news, and the stock has been crashing today, just off the news that they did have a successful merger.
Well, they also had lower valuations than expected.
Mm-hmm.
Yeah, I was looking at it on a technical chart right before the crazy increase, and I was like, it's a little too risky for me. I'm not going to get in, and I would have made pretty good money.
Yeah, I sold the $20 a share. I was so upset.
I think that's just an example of people seeing a trend. People were posting about CCIV on Twitter. People see the trend and they want to get on the trend, and it causes the quick rises like that.
Yep.
It makes you wonder if there's a new market niche. Like, can we just ride trends and see if we can profit off, short-term swings based on just pure speculation?
Trade volume, momentum. Yeah.
Right.
Where does that leave the investing based on macro trends and fundamentals? Does it even matter
Who
anymore?
knows? I guess in the long term,
like
of
our
course.
generation, it's kind of like out the window because I feel like people are just like not that patient and they'd rather just see something on Twitter and then just buy it on their phone versus like look into a company, look at valuations. I feel like it's easier for like people to just be lazy, see somebody.
Yeah.
Post
I
something
think
on social
personally,
media and just act on it and hope for the best.
yeah, I totally agree. And I think I think people have always been lazy, but it was more like, oh, investing is too much work a year, 5 years ago. I'm not even going to bother. Now people see that it's possible to not do any work and still make money. So I think that's why the overall volume of shares being bought and trade activity is increasing, because people are like, oh, I don't have to do much work. Well, I guess I could succeed in this too. So it's just.
I also think it's gone from, okay, I don't care enough about finances. I'm going to put my money in an ETF and let it sit, or I'm going to take my money and give it to a broker and let them invest it for me, to now it's, well, I want to manage my own money. So now it's, and I think that's what's created the rise in retail investors, is people are seeing common people making 1,000% returns on stocks like GameStop, and they're wanting to get more involved and they want to hop on the trends. And I think that's only going to continue.
The FOMO.
Exactly. Yeah.
And all this stuff, I feel like
we haven't been able to bring you into the discussion. What do you think?
Sorry, what was that? My Wi-Fi keeps cutting out.
What do you think? Do you trade?
Well, I'm currently locked out of my E-Trade account, so I haven't been as involved in this, but I've been keeping an eye on it, and it's kind of just been very surprising. Like, it just hasn't seemed to be based on anything of substance, almost like kind of what they were saying, like pure momentum, not actually reflecting how businesses are doing.
Do you think that's going to continue, that people will hear news, will trade on it and take our profits?
I mean, even like the algorithmic trade, softwares do that. News comes out, instant buy, and right now, the retail investor is basically trading against, those institutions and those algorithmics. And in the long run, it really doesn't work out, but I think it definitely will continue. Everybody can trade at the tip of their fingers now at any time of day.
It's not your father's or your grandfather's market.
No. And just to add to that, like I was saying, with people putting their money in ETFs and giving it to brokers like in the past, those are the managers of those ETFs, and those brokers, they're the ones doing the fundamental research. They're the ones investing in value companies. Whereas now, the common investor, the retail investor, isn't going to do a DuPont analysis. They're not going to do a discounted dividend model to get a price target. They're going to hop on trends and just follow the momentum.
Yeah, absolutely. Total change. But we're still going to study fundamentals for the next 12 weeks.
I think it's important to at least have some sort of balance of both. Like me and Joey last semester had a whole project where we did a financial, what would be not an investigation, but analysis of Callaway. And after looking at discounted cash flows and every other element, we're both holding the stock despite, short-term gains or whatever, because, there's still fundamentals, and I still believe over long-term periods of time, fundamentals should prevail.
Yeah, I think we got to look at macro events, macro trends, fundamentals, momentum or technicals, And then the last one would be this. I mean, if I have a company that I believe is going to be favorable macro trends, fundamentals look good, and people are talking about it, I'd be just as happy to keep in it as we're going along.
Mhm.
Other thoughts, questions?